Everyone thinks they'll see the next financial crisis coming. They imagine it like a movie trailer, red charts, breaking news banners, a single terrifying day where the market drops 10% and everyone suddenly agrees something is wrong. And here's the thing, that belief is exactly what guarantees most people will miss it, because the next financial crisis won't announce itself. It won't scream, it won't crash through the front door, it's going to seep in through the walls. Quietly, slowly, psychologically, and by the time people finally admit what's happening, the damage will already be done. Now look, every generation is trained by the last disaster. 2008 taught people to fear banks. It taught people to fear leverage. It taught people to fear housing bubbles. So naturally, people are scanning the horizon for the same monster. But crises don't repeat themselves like reruns. They mutate. They evolve. They exploit the lessons of the last one. Which means the biggest risk today is fighting the last war with outdated weapons. Let me take you back for a second. In 2008, the crisis was obvious because it was violent. Lehman Brothers collapsed. Credit markets froze. The Dow lost nearly half its value. You didn't need a finance degree to know something was broken. You could feel it in the air. Fear was loud. This time, fear is going to be quiet. This time, confusion will replace panic. People won't say everything is collapsing. They'll say, why does it feel like I'm working harder but getting nowhere? That's the signal. Here's what most people don't realize. Financial crises don't start with markets. Markets are the symptom, not the disease. Crises start with incentives. They start when the rules quietly change, but behavior doesn't. They start when people keep playing yesterday's game in today's conditions. And psychology lags reality every single time. Think about boiling water. If you drop your hand into boiling water, you pull it out instantly. But if you heat the water slowly, your body adapts until it's too late. That's how the next crisis works. Slow pressure, delayed reaction, compounded damage. Now you might be thinking, but something has to break. What is it? That's the wrong question. The better question is, what stops working all at once? Because the next crisis won't be one giant explosion. It will be a system losing lubrication. Liquidity will dry up in places people assumed were permanent. And when liquidity disappears, everything feels heavier, harder, stickier. Here's where it gets interesting. For more than a decade, the world lived in an environment where money was artificially cheap. Interest rates near zero trained people and institutions to behave differently. Risk didn't feel risky. Debt didn't feel dangerous. Time didn't feel expensive. When money costs nothing, mistakes don't show up immediately. They accumulate. And between 2008 and today, global debt increased by over $100 trillion. That number is so large it barely feels real. But it matters because debt is a promise against future cash flow. And the future just got more expensive. Now let's talk about the math, because math doesn't care about optimism. When interest rates move from 2% to 5%, people casually call that a 3% increase. That's wrong. It's a 150% increase in the cost of money. That's like your rent jumping by 150% overnight. Same apartment, same landlord, different reality. And here's why that matters. Imagine a business earning $1 billion a year in profit, carrying $10 billion in debt. At 2% interest, they pay $200 million. That leaves $800 million to reinvest, pay employees, buy back stock, or grow. At 5% interest, they pay $500 million. Nothing else changed. But suddenly, nearly half of their profit vanished. No scandal, no mismanagement, just math. Now zoom out. Multiply that across the economy. Companies don't collapse instantly. They cut quietly. Hiring slows. Raises disappear. Budgets tighten. Innovation pauses. And workers feel it before markets do. Now look at households. For years, people were told, buy the house, lock in the low rate. And that advice worked until it didn't. A $500,000 mortgage at 3% costs about $1,600 a month. At 7%, that same loan costs more than $3,300. That's not inflation. That's not greed. That's arithmetic. And when millions of households hit that reality at the same time, consumption changes. Not dramatically. Gradually, people don't riot. They adapt. They delay. They cancel. They choose cheaper options. And businesses that depend on discretionary spending don't crash. They bleed. This is why the next crisis won't feel like chaos. It will feel like exhaustion, like friction everywhere, like pushing a boulder uphill and wondering why life suddenly feels harder. This is where psychology becomes the real battlefield. Humans are wired to react to fast threats. Slow threats slip past our defenses. We normalize pain if it arrives in small doses. We rationalize discomfort. We tell ourselves this is temporary until it isn't. And markets behave the same way. Now, here's another uncomfortable truth. Most people think volatility equals risk. If prices swing wildly, they panic. But volatility is visible. True risk hides inside stability. The most dangerous assets are the ones that feel boring, safe, reliable. In 2007, mortgage bonds were considered rock solid, AAA ratings, institutional favorites. They didn't look risky. They felt safe until everyone tried to exit at once. That's the pattern. When everyone owns the same safe thing, it becomes fragile. Today, the same psychology exists in different forms. Passive investing assumes constant liquidity. Private credit assumes low defaults. Commercial real estate assumes stable demand. Government debt assumes perpetual confidence. None of these assumptions break all at once. They erode. And when liquidity dries up, prices don't decline smoothly. They gap. Funds freeze withdrawals. Buyers disappear. Markets don't clear. This is why the next crisis will confuse people, because nothing will look obviously broken. Things will just stop working the way they used to. Now, you might be thinking, so should I sell everything? Should I panic? No, that's the trap. Binary thinking destroys wealth. The real edge isn't prediction, it's resilience. Financial strength isn't about maximizing returns in perfect conditions. It's about minimizing fragility in imperfect ones. Here's the shift most people never make. Stop asking, how much can I make? Start asking, how much pressure can I absorb? That changes everything. Cash stops being lazy money and becomes strategic flexibility. Low debt stops being conservative and becomes freedom. Multiple income streams stop being hustle culture and become insurance. This is how institutions think. This is how banks think. And this is how individuals should think, but rarely do. Most people never stress test their lives. They never ask, what happens if income drops by 20%? What happens if borrowing costs double? What happens if my job disappears for 6 months? Not emotionally, mathematically, because math doesn't panic. Math clarifies, and clarity is power. The people who thrive after crises aren't geniuses. They're not lucky. They're not perfectly timed. They're positioned, they have margin, they have options. They're not forced to sell at the worst moment. And forced selling is where wealth transfers happen, quietly, from the fragile to the flexible. This is why the next financial crisis won't have a single villain, no headline moment, no obvious collapse everyone points to. It will be death by 1,000 cuts, higher rates, tighter credit, slower growth, stressed consumers, delayed decisions. And while people argue online about whether we're in a recession, the real story will already be unfolding underneath. Here's the paradox nobody likes to hear. Crises don't destroy opportunity, they reveal it. They expose who prepares psychologically instead of emotionally. Because panic feels urgent, preparation feels boring until it isn't. So stop waiting for confirmation. Stop waiting for headlines to tell you how to feel. The future doesn't punish people who are wrong. It punishes people who are rigid. Adaptability beats prediction every time. And when this next crisis finally becomes obvious, not in one dramatic moment, but in a slow collective realization, you won't be scrambling. You'll be calm. You'll be liquid. You'll be patient. And patience, in moments like that, is the most expensive asset in the world. That's how you don't just survive history. That's how you use it.